funds spent on buybacks can't fuel innovation. Let's dive into Infosys' massive 18,000 crore buyback. Infosys, India's IT giant, has spent a whopping 75,760 crore rupees on buybacks since 2017, including its 2025 program of 18,000 crores, its largest ever. At 1800 per share, it's a 19% premium over the current market price, and it's repurchasing around 2.4% of its equity. This is a big win for investors. So what does this buyback mean for the Infosys books? The buyback reduces its 40,000 crore cash pile, but Infosys is also debt free, and it has a 34,000 crore free cash flow in the year FY25. So it strengthens its earnings per share, which is already up 5.7% annually from 57 rupees in FY23 to 64 rupees in FY25, and boosts returns on equity, keeping these financials attractive. But here is the rub. Not every investor will cash in fully. Past buybacks saw 2 to 3x oversubscriptions, meaning only 30 to 50% of the tendered shares might be accepted due to high demand. So if you have Infosys shares, will be notified via brokers. There are no direct calls, and if you submit your willingness to give those shares, you do it on the broker's platform in the 7 to 8 day window that follows this announcement. Let's look at Infosys' share prices and returns from September 20 to September 2025. The stock appreciated 42% with about 7.2% CAGR. Its highest was 1862 in 2021 because of the digital boom, but it retreated back to 1300 in 2022 based on macro pressures. So buybacks provide short-term pops, 2 to 5% after every announcement. But overall, on a 5-year, the TSR was just 51%. It's a lot more than steady. But what it misses is the big tech riser. Now, let's talk opportunity cost. Infosys' 75,000 crore buyback dwarfs its 15,000 crore R&D spend over 5 years. In FY25, the R&D was just 850 crores, which is just 0.54% of 1.5 lakh crore revenue. While broader AI innovations, including platforms like Topaz, hit 3,000 crores in R&D. That's a 4:1 bias towards buybacks over R&D. Now let's compare this to the other tech's rising stars. In the same period, Nvidia's revenue has grown 317%, fueled by 20% R&D spend. Microsoft Azure grew 39%, driven by $245 billion in R&D investments. Amazon's AWS is up 122% since 2020, and it is investing $85 billion in R&D. Infosys serves these giants but relies on their innovation, missing IP ownership and potential 5 to 10% revenue boost if it is matching their R&D. There are good examples even in India. Look at Tata Motors and Mahindra & Mahindra. Tata has invested 5.5% in R&D, launching 10 EV models and captured 70% market share. The revenue was up 76% since FY20, almost a turnaround. Mahindra & Mahindra spent 5.7% and it dominates the SUV sales in today's day. The CAGR is about 43%. So these firms transformed India's auto from a 1% EV penetration in 2020 to more than 10% in 2025, creating jobs, exports. Infosys could do the same in IT with cash, but buybacks diverts it from such pivots. Prioritizing payouts over innovation caps growth in this AI-driven market. Diverting funds to R&D could be a better bet for the long-term gains. Infosys' strategy, favoring buybacks over transformative AI, repeats the mistake of underinvesting in R&D, threatening its relevance as competitors are racing ahead. So investors, the 2025 buybacks offers cash now, but with partial acceptance of the risks and limited upside. So is it worth it? Or should you chase high growth innovators or park your money in the people who are investing in R&D? Tell us, a cash cow or a fading star as part of your portfolio? Thank you for tuning into Hedgenomists. Like and subscribe if you like this content. See you next time.